Hello and welcome. Today I'll show you how to perform a candle volume analysis using Wyckoff method. We'll cover multiple scenarios for anticipating tops and bottoms, and I'll also reveal a powerful strategy to follow the smart money using a simple candlestick pattern. So if you could, like, subscribe to the channel, and stick around for the full video. Nearly a century ago, Richard Wyckoff began to publish his methods of detecting supply and demand imbalances in the market. Wyckoff introduced his discovery that it was possible to measure the force of buying and selling pressures in any traded market. Wyckoff's method proved that future price moves were foreshadowed on the price chart because the composite man, or the smart money, must leave its trading footprint on a price chart due to the sheer size of its trading volume. So it's the supply and demand imbalances created by smart money that is the cause of price movement. Their activity is measured with four simple variables: the price movement, meaning the high, low, and closing price; the trading volume, the relationship between the price movement and volume, and the time it takes for the price movement to run its course. This combined methodology is known as Wyckoff candle volume analysis. In this video, I will apply Wyckoff candle volume analysis on a one-bar reversal pattern known as the doji. You know it very well, probably. This is a candlestick pattern that occurs when the opening and closing prices are the same or very close to each other. The shadows can be either long or short, and there can be various types of doji bars. But for our strategy, it's not important to distinguish the type of the doji formation. It's only important to be able to recognize what it looks like on a chart. This formation is said to represent market indecision because the market opens, trades throughout the period, and then closes at or near the opening price. It represents a battle between bulls and bears that neither won. It's widely believed that it represents a better reversal pattern at the top of the market than at the bottom, although you will learn that this is not correct under the proper circumstances. By applying Wyckoff candle volume analysis, you will learn how to distinguish when there is no indecision in a doji formation. The perfect doji has the same open price and close price. However, if the difference between the open and close prices is within a few ticks, this could also be considered a doji. A doji candlestick suggests a lack of control in the market, either by the bulls or the bears. The lack of direction is clear. Bulls move the price higher, bears move prices lower, but in the end, the market price closed exactly or very close to where it opened. But if the doji candle highlights market indecision, it's safe to say that it doesn't offer insight into whether supply or demand is in control. You have to guess the market's next direction. This is where Wyckoff candle volume analysis will make the difference. At the bottom of a market, a Wyckoff technician is looking for tests of supply in the market. A test occurs when the price is marked down to see if greater volume comes in at a lower price. If it does, this signifies supply is in the market. This supply must be removed before the market can begin any substantial up move. However, if the market is marked down and no sellers emerge at these lower prices, the price will come back up to close off the low, while volume is lower relative to the prior candles. With no supply present in the current price level, the price should rise. The doji test bar must exhibit the following parameters to be valid. It must have a low that is lower than the previous candle's low, and it has to display lower volume than at least several of the prior candles. The lower the volume, the stronger the indication of no supply being present. Here's an example on the 1-hour chart. Notice this obvious downtrend, with price starting to make higher highs and higher lows. Now we are in a slight consolidation, and we don't know if the price will go up or down. And here's our doji test bar. Looking left on the chart, a few candles prior to the doji, the high was here at around $218. Then the market dropped around $8 to the low of the doji. This sets up the ideal conditions for this formation to occur. Pay attention. The test candle, the doji bar, makes a new recent low, and if there is reduced volume, it shows that no supply is present. So you can see that this doji is making a new low on the chart, and the volume is lower than the previous two candles. By standard candlestick analysis measures, most traders would come to the conclusion that this bar represents indecision on the part of the market participants. Breakout traders would even enter short, as the doji test bar is making new lows. However, when viewed from a Wyckoff candle volume analysis perspective, it's clear that no indecision exists here. The chart shows that there are a few sellers at this lower price, and the price comes back to close near the open. Within the next bars, this market started making higher highs and higher lows, and increased almost $5. With this formation, it's important to understand that the smart money, which represents a large percentage of the overall trading volume, is not selling as lower price levels are explored. This is clearly evident and is shown by the reduction in the total volume. If the smart money is not selling, you, as a retail trader, need to be aware of this. This will prevent you from selling at market bottoms and will allow you the opportunity to establish a long trade into the path of least resistance. This example shows a 15-minute chart. Again, in the background is a pretty strong downtrend. Around 10 candles prior to the doji test bar, the high price was around $225 per share. The low of this doji test bar was at $220, which represents more than a $5 drop in the value of the stock. Once again, notice how the volume gets lower as the doji candle tests for supply, but doesn't find an increase in interested sellers at these lower price levels. You can see that this doji is making a new low on the chart, and the volume is lower than the previous 3 candles. If there are no sellers, the price should increase. The price of this stock rose nearly $2 as there were no sellers present to stop it from increasing in value. Now let's look at the doji at the top of a market. This formation is called doji demand drying up. At the top of a market, a Wyckoff technician is looking for signs that demand is diminishing. A lack of demand occurs when the price is marked up to see if there are willing buyers at these higher price levels. But as the price moves up, trading volume decreases. There is a telling sign that there is no interest in higher prices from the smart money. With no professional buying interest at the current price level, the price should fall. The doji demand drying up must exhibit the following parameters to be valid. This candle's close must be higher than the previous candle's close, and it has to display lower volume than at least several of the prior candles. The lower the volume, the stronger the indication that the demand has dried up. Here's a 30-minute chart of the S&P. Preceding the 2 dojis marked on the chart, you can see that the market has been in an uptrend. As the market moves up to the highest point, the amount of interested buyers is drying up. We know this because the volume is greatly reduced compared to the previous candles, even though the S&P is making a new recent high, and strong markets don't behave this way. This occurs at the top of the market, and when we apply Wyckoff candle volume analysis, the doji indicates that at least this phase of the up move is either close to or at the end. Once again, notice how the volume gets lower as the 2 doji candles test for demand, but doesn't find interested buyers at these higher price levels. You can also see that each doji is making a new high on the chart, and the volume is at the lowest level. Several candles later, the market dropped aggressively. With this formation, it's important to understand that the smart money is not interested in supporting higher prices. This is evidenced by the reduction in the overall volume. If the smart money is not interested in higher prices, you as a retail trader can take this knowledge and refrain from buying at market tops. Instead, you will establish a short trade into the path of least resistance. Here's an example on Bitcoin. Notice this aggressive up move, with price making higher highs and higher lows. The test candle, the doji bar, makes a new recent high, and the volume is lower than the previous 6 or 7 candles. By standard candlestick analysis measures, most traders would come to the conclusion that this bar represents indecision. But when viewed from a Wyckoff candle volume analysis perspective, it's clear that no indecision exists here. The chart shows that there are a few interested buyers at this higher price, and the price comes back to close near the open. Whenever you see a doji on low volume that appears in the context of a bullish uptrend, this should give you some warnings that a trend correction could come at any time. Once you identify the candlestick pattern, you will want to find a trigger that lets you know when to enter the trade. A simple trigger is the low of the doji. Once the candle closes below this level, you can open a short position. The aggressive entry would be immediately after the candle closes. The proper location of a stop loss is above the high of the doji. Your level of risk will vary depending on the length of the candlestick wick. Ideally, you want to have your reward, your take profit, at least double your risk. A first profit target equals the size or the range of the doji candle. This would give you a roughly 1-to-1 reward to risk ratio. Not ideal, but at least you can lock in some profits. The second profit target is double the size of the doji. This will get you closer to a 2-to-1 reward to risk ratio. Wyckoff candle volume analysis works in all markets and timeframes and precisely reveals the true psychology and the sentiment of the smart money. This technique will help you prevent buying market tops and selling market bottoms. I advise you, however, to avoid smaller timeframes like the 1-minute or the 5-minute charts because you'll witness many false signals, and it will be hard to see the big picture with all that market noise. If you learned something new and want a follow-up video on this topic, please hit a like button since it really helps us out, and subscribe to stay up to date with our latest releases. And check out our Academy program if you want to further level up your trading. Until next time.